WeWork didn't collapse because it grew too fast. That is the common surface-level explanation. It is simple, dramatic, and ultimately misses the point. The real failure was more fundamental, more structural. It is far more instructive for anyone building a business. It is even instructive for someone's career. The company's real downfall came from a different kind of imbalance. WeWork collapsed because its growth continuously and aggressively outpaced its structure. It built a global empire on a foundation that could not support the weight of its own expansion. This is not a story about speed. It is a story about the critical sequence of building a sustainable enterprise. Growth, when applied to a weak structure, does not fortify it. Instead, it acts as an accelerant, finding every crack and widening it until the entire system fails. This distinction is crucial. Many companies pursue rapid growth and succeed. The difference lies in what they are scaling. Are they scaling a profitable, repeatable model, or are they scaling complexity, commitments, cash burn? WeWork's narrative was built on the aesthetics of growth, more locations, more members, and a soaring valuation. But beneath the surface, the core operational engine was not built for sustainable profitability. It was engineered for expansion at all costs. This created a profound structural fragility. The very act of growing made the company weaker, not stronger. We will not be recounting the dramatic rise and fall in a documentary style. There will be no nostalgic look back at the free-flowing kombucha, nor at the charismatic founder. Instead, this is a structured corporate risk breakdown. Our analysis will be calm, measured, and focused on the mechanics of the failure. We are here to understand the how and the why from a strategic perspective. The goal is to extract a timeless lesson about the relationship between growth, cash flow, and operational integrity. We will diagnose the specific points of failure as a case study in structural risk applicable to any organization, large organizations, small organizations, and even an individual's financial life. This analysis is built for professionals, entrepreneurs, and strategic thinkers who value structured thinking over surface-level advice. Our objective is to move beyond the headlines and provide a clear, evidence-based framework for identifying similar risks in other ventures. The story of WeWork is not just about one company's spectacular implosion. It is a powerful lesson in the universal principles of building something that lasts. It teaches us that ambition must be matched by architecture. Expansion must always follow, never lead, structural stability. To understand WeWork's structural fragility, we need a clear framework. We will evaluate its business model across three specific measurable dimensions: unit economic stability, cash burn velocity, capital dependency ratio. These are not complex financial derivatives. They are fundamental indicators of a company's operational health. Together, they form the unsustainable expansion model. This model applies when growth outpaces internal cash generation. It shows when growth exceeds stable internal cash flow. The first measure, unit economic stability. Does the core offering make a profit? For WeWork, that's profit per location. We will analyze whether the average WeWork office was profitable after all costs, long-term lease obligations, high cost of custom build-outs, member perks and amenities. Second measure, cash burn velocity, the rate at which a company spends its cash reserves. How quickly was WeWork burning through capital to fund day-to-day operations, to fuel aggressive expansion? Third measure, capital dependency ratio. It quantifies reliance on external funding, calculated as outside investment need divided by internal ability to sustain operations. A high ratio not self-sufficient and vulnerable to investor sentiment and market conditions. For WeWork, that dependency was extreme. We'll break down how reliance on investor capital created structural fragility, where perceived growth outpaced real profitability, leading to high-risk decisions that sealed its fate. Throughout, we provide a structured risk breakdown based on historical evidence. For each measure, we will define the risk, show the data, identify ignored warning signals, explain direct structural consequences. This is not an academic exercise. Lessons from WeWork's failure have direct applications. At the end, we'll translate this corporate framework into a personal one, offering a tactical plan to assess your financial structure. We'll introduce the lifestyle expansion ratio, a tool to measure whether your commitments outpace financial stability. The goal, your growth, career, and life built on strength, not fragility. The first measure in our framework is unit economic stability. This is the bedrock of any sustainable business. In its simplest form, it answers a critical question. On a single repeatable unit of your business, are you making more money than you are spending? For a software company, the unit might be a single customer subscription. For a retailer, it might be a single product sold. For WeWork, the primary unit was a single physical location. The stability of the entire global enterprise depended on the financial health of each individual office space it operated. If the average WeWork location could not generate a profit after all its associated costs were accounted for, then the company was not scaling a business. It was scaling a liability. WeWork's public narrative skillfully directed attention away from this fundamental question. The focus was always on macro-level metrics like total revenue, number of members, number of cities and countries it was entering. These figures were impressive and fueled a story of unstoppable global domination. However, they were vanity metrics that masked a deep-seated problem at the core of the operating model. Revenue growth is meaningless if the costs required to generate that revenue consistently exceed it. WeWork was mastering the art of generating revenue, but it had not yet figured out how to translate that revenue into profit at the individual location level. True unit economic stability requires a model that is profitable after paying the long-term lease, covering the astronomical costs of transforming a raw space, paying the community managers, providing all the promised amenities. There is still cash left over. This positive margin is the engine of sustainable growth. The assumption was that with scale, efficiencies would emerge and profitability would naturally follow. This is a common belief, often referred to as blitzscaling, However, this strategy is only viable when the underlying unit economics are fundamentally sound. WeWork's model had structural flaws that scale did not fix. Instead, it magnified them. Each new location was not a step towards profitability, but another leak in a ship that was already taking on water. To understand why WeWork's unit economics were unstable, we must dissect the costs. The largest and most inflexible cost was the long-term lease, often decade plus. On the other side, its revenue came from short-term membership agreements, often on a month-to-month basis. This created a fundamental asset-liability mismatch. Beyond the lease itself, the second major cost was the capital expenditure required for build-outs. WeWork did not just rent office space, it completely transformed it. This involved extensive construction, high-end interior design, custom furniture, installation of complex IT infrastructure. These costs were enormous, often running into millions of dollars per location before a single member moved in. On top of these foundational costs were the ongoing operational expenses. Each location required staff, cleaning crews. There were utility bills, security costs, and the continuous expense of stocking amenities like coffee, snacks, the infamous beer on tap. Furthermore, to attract and retain members, WeWork often resorted to significant pricing concessions. Enterprise clients, who were crucial for filling large blocks of space, were frequently given deep discounts that further eroded the potential profit margin of a location. When you assemble these pieces, the financial picture of an average WeWork location becomes clear. It was an operation burdened by high fixed long-term costs and massive upfront capital investments funded by flexible short-term revenue that was often discounted. This wasn't a temporary issue affecting a few new locations. It was a systemic flaw embedded in the core operational DNA of the business model itself. The most glaring warning signal was the consistent divergence between headline revenue growth and underlying profitability metrics. In its filings, WeWork celebrated its skyrocketing top-line revenue, which grew from $436 million in 2017 to $1.8 billion in 2018. However, during that same period, its net losses also ballooned from $890 million to a staggering $1.9 billion. The fact that losses were growing even faster than revenue was a clear red flag. It indicated that the fundamental business was becoming less profitable as the company grew, not more. This is the opposite of what one would expect from a business achieving economies of scale. Another ignored signal was buried within the company's own non-standard financial metrics. WeWork introduced a metric called community-adjusted EBITDA, which was essentially a measure of profitability before accounting for most of its major costs, including rent, build-outs, marketing, and administrative expenses. While the company argued this showed the core health of its community operations, it was a misleading indicator that painted an artificially rosy picture. A business that claims profitability before paying for its primary product, the physical space, is not demonstrating operational strength. The company's strategy was to enter new markets so quickly that the losses from immature locations constantly obscured the performance of more mature ones. Instead of pausing to allow its existing portfolio to stabilize, the company accelerated its expansion. But here's where it became dangerous. The market, fueled by a venture capital ecosystem that prioritized growth above all else, chose to believe the narrative over the numbers. The soaring private valuation of $47 billion created a reality distortion field. This valuation was not based on WeWork's unit economics or cash flow. It was based on the belief that it was a technology company, not a real estate company, and would therefore command a tech multiple. This belief allowed the company to raise billions of dollars, which in turn funded more money-losing growth. The warning signs were not just ignored, they were actively rationalized away, creating a feedback loop of unsustainable expansion. The primary structural consequence of unstable unit economics was that WeWork was not scaling a business, it was scaling its losses. For WeWork, each new location was like adding another floor to a skyscraper built on a crumbling foundation. The bigger it got, the more certain its eventual collapse became. This dynamic created a voracious and ever-increasing need for capital. Unstable unit economics, increased cash burn, capital dependency, structural collapse. Because the core operations were not generating cash, the only way to fund the losses was through external financing. This put WeWork on a treadmill. forced to raise larger and larger sums of money at a faster and faster pace. The business had no internal mechanism for self-sustenance. It was an external combustion engine that would stall the moment its fuel line, the flow of venture capital, was cut off. This created a vicious cycle where poor unit economics led to a need for capital, and the need for capital drove behavior that further worsened the unit economics. The unstable unit economics were not a temporary problem of a young company. They were the fatal architectural flaw at the very center of the enterprise. The collapse was not a matter of if, but when. WeWork expanded faster than its profitability. Growth without structural profitability is fragility. For you, this translates to: are your lifestyle upgrades outpacing financial stability? Measure your lifestyle expansion ratio, fixed lifestyle costs, stable income. If that ratio climbs with every raise, you're building fragility. Stabilize. 1. Lock 50% of raises into liquidity. 2. Cap lifestyle expansion at 20% of income growth. 3. Maintain a fixed cost ceiling. Expansion must follow structure. Growth amplifies whatever structure you already have. If the foundation is weak, expansion accelerates collapse. In the next corporate risk autopsy, we examine Yahoo and the strategic drift lesson.